Welcome back to Real Estate with CT. It's your host, Christopher. So listen, I got a question about the difference between an RCV policy versus an RC policy versus an ACV policy when it comes to a property claim. So let me explain the difference between the two policies. An ACV policy stands for actual cash value, and an RC policy is a replacement cost. And so what that refers to is the damage to your roof. So with an ACV policy, what's going to happen is an adjuster is going to come out. They're going to assess the damage to your roof. They're going to assess if it's covered under your policy through hail, wind, or whatever the perils are. And so if it is a covered claim or it's damage that's covered, then the ACV, the actual cash value policy, they're going to depreciate your roof based on the type of shingle. So if you have a 25-year 3-tab shingle or a 30-year architectural shingle, they're going to see how long the shingles have been on. So if you have, let's just use the 25 years as an example, because that's more common. So if you have a 25-year 3-tab and it has been on for 15 years, then you have 10 years of usable life left. So they're going to depreciate those 15 years. So let's just say that the roof costs $10,000 to put on brand new, but at 15 years, you've used 60% of it. So you have $4,000 of useful life remaining. Then they're going to write you a one-time check for $4,000 because basically $6,000 of the 10 has already been used, and they're going to depreciate that down to the $4,000, and they're going to write you a one-time check of $4,000. So usually when they sell those policies, those are a lot cheaper because the insurance doesn't have to pay out as much. So whenever you are shopping for insurance and they say, oh, well, yeah, we can get you an ACV policy, it'll be much cheaper than the replacement cost. Most people don't understand what that means until a claim is filed. That's what it's going to mean. Now, if you get a replacement cost policy, what that's going to mean is the same example of a roof that's $10,000 to replace. Initially, they're going to replace the roof if it's damaged. So if it cost 10 grand to replace the roof 10 years ago, and now it costs 15,000 to replace the roof, they're going to give you the 15,000. But they're going to depreciate but they're going to pay you in two forms this time. They're going to still depreciate the roof, and they're going to give you an initial check of 4,000. And once your repairs are complete and you submit the receipts showing, you or your contractor submits the receipts showing that the repairs have been completed, then they will release the second check to make it whole again. So that's the difference. So hopefully that makes sense. If it doesn't, please leave a comment and I will respond. So until the next one, y'all have a good one.